Okay, let's unpack this. It's a complex, definitely a crucial, and I think an increasingly urgent topic that you shared with us.
It really is.
We're doing a deep dive into the raw mathematics of debt servicing, basically the cost of money.
Right.
And your sources suggest this is activating a kind of financial tripwire, what a lot of people are now calling the debt doom loop. And it's happening in real time.
Exactly. This deep dive isn't really about, abstract economic theory. It's about some pretty unforgiving arithmetic.
Right.
Our mission today is to understand precisely why the cost of servicing this massive U.S. government debt is accelerating so fast, how that math physically crowds out other critical parts of the federal budget, and crucially, what the three unavoidable ways out of this trap really are.
Okay, so to get the gravity here, we have to start with just the sheer magnitude of the current cost. For the fiscal year that just ended, 2024, the United States government spent $882 billion.
Just paying interest.
Just paying interest. Not on education, not on tanks, not on healthcare, just the interest bill.
And that number, $882 billion, it really requires some perspective to understand.
It does. So here's the key takeaway right out of the gate. That interest expense is now larger than almost every other major federal expenditure. It's more than the entire defense budget. It's more than everything the government spends on veterans' benefits, education, and transportation combined.
Wow.
When you actually look across the federal ledger, only Social Security costs more than the money we send to bondholders every single year.
And if you look at the trajectory, where this is headed, the problem only intensifies.
Right.
Current projections show those annual payments rising to $1.8 trillion by 2035.
1.8 trillion.
And by the middle of the century, interest payments are projected to become the single largest expenditure the federal government makes. It'll surpass defense and Social Security.
So what we're saying isn't just that the debt pile is big. We're saying the underlying mathematical relationship of servicing that debt has fundamentally turned hostile.
That's the core concept. The size of the debt. It only really matters relative to two things: the interest rate you pay and the rate at which your income grows.
Which brings us directly to the end of what we could call the free lunch era. I mean, for nearly 40 years, the U.S. government had this extraordinary financial tailwind.
It really did.
Interest rates just kept falling, driven by all these global forces, while economic growth, generally continued. This allowed the government to borrow more and more, while the cost of servicing it all actually remained pretty manageable.
And what's fascinating here is how quickly and how definitively that era just slammed shut.
2022.
2022 was the turning point. The Federal Reserve, trying to tame inflation, just aggressively raised short-term rates. And that single policy shift has now doubled the average interest rate the Treasury pays on its debt since 2020.
And what's that average rate now?
It's standing at 3.28% and it's still climbing.
And crucially, what is our expected long-term income growth, to offset that rising cost?
Well, our long-term economic growth projections are still pretty modest. They're hovering somewhere around 2%.
So there's the mismatch.
That is the critical misalignment that activates the doom loop. I mean, if the interest rate you're paying on your debt, let's call it A, is higher than the rate your income, your GDP, is growing, let's call that G, then the debt burden automatically increases. It gets bigger relative to your ability to pay, even if you stop borrowing new money.
And we are emphatically not stopping. We are running a structural deficit that's, over 6% of GDP right now?
That's exactly why we're in the loop. High debt leads to high interest payments. Those high interest payments automatically swell the deficit. And larger deficits require more borrowing, which generates more debt. This spiral just feeds itself.
So the Treasury has to borrow money just to pay the interest on old borrowing.
It's no longer a hypothetical model. I mean, the mechanism is fully engaged.
And that transition from, abstract math to concrete budget reality is where the pain really starts to show up. The speed of this is just unnerving.
It is.
From $345 billion in interest in 2020 to $882 billion today. Nearly tripled in 4 years.
We could track that acceleration pretty clearly. The CBO, that's the Congressional Budget Office, they do the nonpartisan scoring for Congress. They project that interest costs are going to breach that psychologically important $1 trillion barrier by December 2025.
$1 trillion a year.
But if you zoom out to the next decade, the long-term cost is just astronomical. $13.8 trillion in interest payments over the next 10 years.
$13.8 trillion.
To put that in perspective, that's nearly double what the government spent on interest over the previous 2 decades combined.
So that brings us squarely to this idea of the crowding out effect. If that interest payment is mandatory, it's non-negotiable. What does that do to everything else?
It squeezes everything else. By 2035, projections show interest consuming 22.2% of all federal revenue.
Wow.
So imagine this. For every dollar collected by the IRS, 22 cents is immediately earmarked for bondholders before the government can fund a single school, a single mile of road, or pay a single soldier.
So it limits your ability to respond to a crisis, to invest in anything.
Absolutely. It crowds out the government's ability to respond to recessions, limits infrastructure, constrains national security, and unlike the defense budget, you cannot cut interest payments. They are legally owed.
And this isn't just some slow future drain. You pointed out a massive immediate pressure point, the maturity wall.
Yes, it's the mechanism that translates these abstract rate hikes into immediate concrete budget pain. In 2025 alone, approximately $9.2 trillion in Treasury debt matures.
$9.2 trillion.
It hits a wall, and it must be refinanced immediately. That is 1/3 of the entire Treasury market rolling over in a single year.
But wait, I mean, $9.2 trillion in refinancing? That sounds like a massive risk. Why isn't Wall Street panicking about a liquidity crunch if they have to absorb that much new debt?
Well, Wall Street isn't panicking about liquidity, not yet, because the government will pay whatever rates are necessary. The panic is on the budget side. Most of that debt was issued when the Fed kept rates near zero. Now when it matures, the Treasury has to replace it with new debt paying 4 or 5%. That immediate jump in the rate on nearly 1/3 of the national debt is the reason the payments are skyrocketing so fast.
We're constantly replacing cheap, old borrowing with expensive new borrowing.
That's it.
This all sounds incredibly dire, but here's the counterargument we always hear. The U.S. survived the 1980s. Paul Volcker hiked the Fed funds rate to 20%. The U.S. ran deficits, but we grew our way out of the problem. Why is today any different?
And this raises a really important question because that 1980s comparison, it misses two crucial pieces of historical context. The main factor is just the sheer leverage we have today.
Okay, give us the numbers on that leverage difference.
In 1980, our debt-to-GDP ratio, which is the fundamental measure of debt relative to the size of our economy, was only about 35%.
35%. And today?
Today, it is about 125%. That's almost 4 times higher.
4 times.
So if you're 4 times more indebted, a 1% rate increase today has the same fiscal impact as a 4% increase did back in 1980. We're just exponentially more sensitive to rate changes now.
That leverage difference is staggering. But beyond the numbers, what structural advantages did the 80s have that just aren't available to us today?
Well, the 1980s had these massive tailwinds. First, demographics. The baby boomers were moving into their prime working and tax-paying years, which expanded the revenue base.
Right.
Today, demographics are working against us. We have an aging population, more retirees drawing benefits, fewer workers supporting them. The Social Security Trust Fund, for instance, is projected to be depleted in the mid-2030s.
Which means the government will have to issue even more debt just to pay existing benefits.
Exactly. Then there's the geopolitical shift.
The peace dividend.
Precisely. The end of the Cold War eventually resulted in a peace dividend, allowing cuts to defense spending relative to GDP. Today, we are seeing the exact opposite.
Calls for rearmament, supply chain resilience.
All of it. And of course, the refinancing trend has completely reversed. From 1981 until 2021, bond yields steadily declined. Every maturing bond was refinanced at a lower cost. Now we are running that film backward. Every maturing debt costs us more.
And this reversal is what leads influential economists like Larry Summers to suggest that the neutral interest rate has actually risen permanently.
His argument is pretty compelling. Summers points to global structural shifts, massive capital demands for the energy transition, greater defense needs, reshoring supply chains, all competing for limited capital.
So the idea that we can just wait for rates to fall back to zero might be a fantasy.
Could be a very dangerous gamble for our budget planners, if he's right.
Okay, let's pivot to this critical distributional question. Who is on the receiving end of this $882 billion? Where is all this wealth flowing?
It's a great question. Roughly 1/3 of that massive interest payment, so nearly $300 billion a year, it just flows abroad to foreign holders of Treasury debt. Japan, China, sovereign wealth funds, European institutions. That represents a direct leakage of nearly 1/3 of the interest bill from the domestic American economy.
And domestically. Who are the beneficiaries here?
Domestically, the other 2/3 flow primarily to financial institutions, large funds, and the wealthiest households who own the majority of financial assets. And it's also important to note, the Federal Reserve itself is a big holder.
Wait, explain that part, because that's a crucial nuance. Doesn't the Fed send its profits back to the Treasury?
Normally, yes. When the Fed engaged in quantitative easing, they bought treasuries. The interest income they earn is typically remitted to the Treasury. But because the Fed is now paying high interest on trillions in bank reserves.
So the ones the banks hold with it.
Exactly. The Fed is actually operating at a massive loss. They're running a negative capital balance. So instead of being a source of revenue for the government, that vital flow of funds is broken for now.
So even domestically, this system acts as this huge generational and wealth transfer mechanism.
Absolutely. The tax burden to service the debt falls broadly on the working population and general taxpayers. Meanwhile, the income, the interest, it accrues disproportionately to capital owners.
Every dollar spent on debt service is a dollar not invested in public productivity.
And it funnels wealth up the economic ladder.
So what does this all mean for you, for the average person listening? This raw financial math translates into, what, 4 key implications starting now?
First is the disappearance of fiscal space. So when the next recession inevitably hits, the government's ability to inject stimulus or provide aid will be severely constrained by these mandatory interest payments.
Second, the math demands a resolution. Taxes will almost certainly have to rise, or spending on core benefits like Medicare will have to be cut. The interest bill is non-negotiable, so the money has to come from somewhere.
Third, and this is probably the path of least resistance, is inflation. If policymakers lack the political will for painful cuts or big tax hikes, they will inflate their way out. Higher, persistent inflation erodes the real value of the debt. It's kind of stealth default on bondholders.
They get paid back in dollars that are worth less.
Exactly. And finally, the Federal Reserve's political independence comes under massive pressure. The central bank may eventually be forced to prioritize funding the government's borrowing over aggressively fighting inflation. When push comes to shove, history suggests central banks often prioritize government solvency.
So the verdict then?
The verdict based on the sources is this. The interest payment trap is not a future projection. It is a present reality. The doom loop mechanics are now activated.
Let's unpack the 3 paths to resolve this, because the U.S. won't technically default, right? It controls the printing press. So it's a question of how we default, not if.
That's a great way to put it. Option 1 is the miracle scenario, a major productivity boom. Think of AI boosting growth well above the prevailing interest rate. If G suddenly spikes above her, we could grow our way out of the problem.
Unlikely to bet on.
It's the least likely path to rely on, yes. It requires a massive technological shock.
Okay, option 2.
Option 2 is genuine fiscal consolidation. Massive, politically painful spending cuts combined with meaningful tax increases. Given the current political polarization, this seems highly improbable.
Which leaves the last one.
Which leaves option 3, the most likely path. Financial repression. This is a subtle, corrosive mechanism where the government holds nominal interest rates persistently below the rate of inflation for an extended period, maybe a decade or longer.
How does that actually work for someone holding a bond or just saving money?
It works by forcing savers to pay the price. It involves regulations that basically force domestic institutions like pension funds and banks to hold government debt. Then the government ensures that inflation runs higher than the interest it's paying.
So it's a quiet default.
It's a powerful and quiet mechanism. You might get back the $100 you loan the government, but due to, say, persistent 4% inflation over 10 years, that $100 now only has the purchasing power of $60 in real terms. The government has effectively defaulted on the real value of the debt, and the saver paid the cost.
So the most likely path involves a slow, quiet erosion of purchasing power, a soft default disguised as policy, and the debate between economists like Blanchard, who thinks rates might fall again, and Summers, who thinks they've structurally risen, that's almost secondary.
Precisely. The $882 billion in payments are due now. Regardless of who is right about the long-term rate, the future is already here. You just have to read the balance sheets.
This entire conversation sets the stage perfectly for our next deep dive. If the math is so clearly hostile, why do some people continue to advocate for endless government borrowing? We'll be examining the intellectual framework that tries to justify this, modern monetary theory or MMT.
And why some consider it the most dangerous idea in modern economics. Don't miss it.